Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stock Darts, and we're going to do the typical thing we do on Wednesdays, which is review the markets. We're going to take a look at the four major markets, the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, I'll take a quick look at the U.S. dollar, see what it's doing, see how it's affecting gold, silver, and oil. We have a Fed day today. We have FOMC reporting, so they will probably have a decent impact in the market this afternoon, and could end up being the catalyst that pushes us forward or backwards over the next couple of weeks. For those of you that are regulars, you know I'm kind of favoring the chances of a Christmas rally, but I think we'll get a little bit more clarity on that once we see what the FOMC statement is for today, and what the Fed's plan is as far as, I guess, the approach to next year goes. If you like what you see today, you can always follow me on Twitter at StockDarts, or find these videos on YouTube at StockDarts as well. Or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas as well as reposts of these Wednesday market reviews. Sometimes it's just watch list stuff, names that I'm putting on watch lists and what I'm looking for, things like that. If you're into that sort of thing, go ahead and visit me on there, and you'll see a lot of content that I've posted over the last year and a half now, I think. Other than that, we can go ahead and get started. We can take a look at the four major markets. We're going to go ahead and start with the S&P 500. Alright, so here's a look at the ETF SPY, which of course is the proxy for the S&P 500. And for those of you that were here last week, you'll know that we were expecting the market to probably stabilize over the next week, which was from last week to this week, and sort of trade sideways and consolidate. And that's kind of what's happened. As you can see over the last 4 days, it's been very, very tight price action. Not a lot going on as far as the market trying to move one way or the other. We have encountered some decent resistance at these all-time highs, but the good thing is that the sellers have had no impact on the market as well. And we've been just sort of trading sideways and holding up and basically printing a bull flag as we try to find new buyers to push us towards new highs. I think overall this is still pretty bullish. I don't see anything negative really, other than the fact that we haven't been able to push past this range, but we haven't really spent that much time in this area anyway. So I think overall things are still looking pretty good, and I think it's still moving towards the possibility of a strong rally as we head into the holidays. Now, of course, Christmas is only a couple of weeks away, so we don't have a lot of time left to rally into it, but I still think that there's a very good chance that we rally, and possibly after today's FOMC statement, maybe that's what we need to finally get that lift off. If not, then we'll see what happens over the next couple of weeks, or maybe we don't rally until the start of next year. But I think overall, the way the market is shaping up, I still think it looks like there's more chances that we rally, and rally strongly rather than pull back, or more importantly, to pull back strongly. I think if we do pull back from here to next week, or from here to Christmas, it'll probably be pretty benign. I don't think it'll be anything drastic, and it'll probably just set up a nice little buy the dip opportunity. I think at this point, with the sideways price action that we've gotten over the last 3, 4, 5 days, it's done a good job of resetting some charts that were getting a bit stretched out, and I think overall we're starting to see a little bit more opportunity here to trade to the long side, and it's just a matter of finally getting that breakout. And once we do, there should be some charts that are setting up nicely that are going to give us nice risk-reward opportunities to go ahead and follow the price action and the momentum upwards. Now, looking at the S&P 500 again, looking at SPY, you can see the last 4 days have been basically trading in a very tight bull flag. We have, for the most part, maintained the price action above the 20-period moving average. I'm not going to keep that trend line up there. I just wanted to show the tight price action over the last 4 days. We can zoom in a bit. And the key levels that we want to watch now, as far as trying to figure out whether we're going to pull back, or if we do pull back, just how far we'll pull back. If we do end up, say, reacting poorly to whatever the Fed says today in the FOMC statement, well, we've got the 20-period moving average right here. Now, I suspect that might just be as far as we drop. But if we get a negative reaction, and really the market doesn't like what the Fed is saying, then I think that the real level of support here is down at around 307, 308, which was where we hammered not that long ago, just a week and a half ago, which would also be getting close to where the 50-period moving average would come up and meet price by the time we came down to that level. And I think that would be a good spot to go ahead and buy the dip. And I think that would be more indicative of a market that's still trading sideways as it consolidates this last ramp up we had in November and still is trying to set up for a stronger move to the upside. So basically, if the market isn't ready to break out and we do end up spending more time consolidating or more time pulling back, I suspect that the level we're going to come back down to is about 307.50, just above 307. And that would likely be a good spot to buy the dip once we see some support coming in. Now, if we lose that level, there's a little bit more cushion that we can drop without it really affecting the market in the long term. And I'll go to the weekly chart in a second and show you just what I mean by that. But I think this 302 area is going to be a really critical area. And as long as we hold above that, I think in the long term it's still very bullish, and I think that overall we're still set up for a strong rally. Even if we do get some selling in the next 2-3 weeks and we drop down all the way down to that level, I think overall in the long term, as we go to the weekly chart, you'll see that it's still pretty good. And it's still indicative of a nice breakout over the previous levels of consolidation and the previous levels that we've been trading at. So if you take a look here and we look at what we've done on the S&P 500, basically since the end of 2017, start of 2018, we've mostly traded sideways. Now it's been an interesting process as we've moved sideways because there's been some strong trends in both directions. We had a nice pullback to start this, and then we had a strong rally through the first half, or actually through the first 3 quarters of 2018. Then we had a strong downwards trend to close out last year, and then this year it's been the tale of a couple of different moves. One, we had a very strong trend to start the year, and then we spent most of the summer trading sideways, consolidating and really establishing the price action above that previous range. And I think that's the key here, is we spent that good 3, 4, 5 month chunk of time establishing a breakout and sort of moving past and beyond this 295 to 255 range that we spend most of about a year and a half, almost 2 years in. And at this point, we're well above that. We're printing out. We've basically broken out and started forging upwards. And at this point, what we're looking for is if we do pull back, we just want to establish price action to hold above that, right? So what we want the previous level of resistance to turn into support, which of course shows that buyers are willing to accept what used to be considered an overpriced area as value, and they'll look at that as an area they want to buy now, and not an area that they want to sell at, right? So that's what we're looking for, is that flip to continually be confirmed. So even if we do pull back, even if we have a sharp pullback and we drop a good 13, 14 points, I think as long as we hold above 302, 301, I think it's pretty good. And to tell you the truth, even if we drop all the way down into the 290s, we're still technically above the price range from the last couple of years, but that wouldn't really be a good spot. If we fell all the way, if we broke 302, there's a decent chance that we're going to head back even further down into the 290s, 280s. So we don't want to see that. So for now, that's kind of my line in the sand as far as judging just how bullish the market is. I think if we drop 307, it's not the end of the world. Now, in the short term, I don't want to see us drop 307, of course. I think for my mind, and this possibility of a Christmas rally, we don't really even want to lose a 20-period moving average. I mean, obviously, Christmas is only 2 weeks away. We'd like to see a breakout at the end of today or tomorrow, or Friday at the worst. And from there, we sort of just forge upwards and keep exploring higher price action. And I still think that's the more likely opportunity, the more likely scenario. But, as a trader, we're not just about, our job isn't just to try to predict the market. What we want to do is outline a couple of different scenarios that can occur, and then set up trading ideas or trading setups that will take advantage of whatever ends up happening. So we kind of want to react to what the market does, and so there's an element of predicting and trying to figure out what's going to happen. But the truth is that you don't want to guess and just and say, well, hopefully there's a Christmas rally, so I'm going to buy here. What we want to do is say, well, hopefully there's a Christmas rally. If it does occur, what needs to happen in order for me to buy, right? Or what needs to happen in order for a Christmas rally to be evident on the chart? And so, in my mind, I think at the moment what we want to see is a price break above this 314, 315 area. Once we break above these last 4 or 5 days of price action and start forging towards new highs, I think that's pretty indicative of a market breaking out and a good chance that we get a Christmas rally. And at that point, we should see other charts that are breaking out, and we can go ahead and take advantage of that momentum by buying those breakouts. It doesn't necessarily mean we have to trade the S&P 500. Now, if we don't get a Christmas rally, Or if we need to pull back a little bit further before that happens, well, then that's where I point out these price levels. The 20-pair moving average is the first one, and 307 is the next level. And I think if we fall to those, I'll look for reversal patterns around those areas to see if that's what we need before we, maybe we need a little bit of a shakeout before we go ahead and rally. And if we come all the way down to 307, I think what it means is that the market needs more time to trade sideways. And at that point, I'm still going to trade long, but I'll be looking more buy the dip value sort of scenarios rather than trying to break, play momentum breakouts to the upside. So that's sort of the plan, and that's what we're looking at with the S&P 500 now. Let's take a look at the NASDAQ and see if it coincides or confirms what we're seeing on the S&P 500. So here's the Qs, which of course is the ETF that follows the NASDAQ composite. And as you can see, almost exactly the same as the S&P 500. We've got this 4 or 5 day bull flag going. Right, and for the most part, it's the same sort of thing. We've got a market that's starting to consolidate off of this nice rally that we had in November, and has really just been trying to get enough shares exchanged. Really, this is typical of what happens in a market when you have a move. You have a base consolidation, then you have a breakout or a markup phase, and then once you have that rally sort of start to slow down, you get another consolidation phase, and that's what we're in right now. We're in a consolidation reaction to the last action, if you want to look at it that way. And at this point, we're just looking for new buyers to come in to be able to push the price action through the last highs. And I think overall, it's basically the same as the S&P 500. We've got the 20-period moving average just below price. And in an ultimately really strong bullish scenario, we don't want to see price fall below that. If the price falls below that, there's a good chance we come all the way down to about 200 on the Qs, maybe even a little bit lower. And at that point, we should see a decent buy the dip opportunity, particularly as the 50-pair moving average comes up to meet price, exactly the same as the S&P 500. And just like the S&P 500, if for whatever reason we end up losing that key level, well, we've got another more important long-term level all the way down here around 195. And again, if we look at the weekly chart, you'll see it's almost the same idea as the S&P 500. We've got this range that we spent a good chunk of the summer trading at, which again was establishing the price action above the previous range that we spent the last year and a half, almost 2 years in. And as long as we pull back, as long as we hold above that level, I think it's still all systems go, and it's just a matter of the markets needing a little bit more time to get their act together before it's continuing or resuming this upwards climb. If we do lose 195 and we start to head back into this range that we spent most of the summer trading in, excuse me, then I think at that point we need to be a little bit more cautious, as we'll kind of get stuck in this trading range that we spent a good amount of time in. And it might be indicative of a market that just didn't have enough juice to really break to new highs. And at that point, we'd have to kind of see where we go and what our next levels of support are. So if we lose 195, that's the point where I think we need to start reevaluating where we stand in the markets and what the market is capable of doing. But as long as we're above that, I think that we should be very bullish and looking to trade to the long side with really very little reservation. Now, it doesn't mean we want to ignore our normal discipline as far as how we want to trade. You still want to stop out of trades. You still want to be careful about what you enter in. But you don't need to be quite as cautious, particularly in how many positions you allocate, as long as the market's trading that strongly. Now, there's not really much else I want to say about the NASDAQ that we didn't already say with the S&P 500. I think they're both trading very closely, and they're both doing sort of the same thing. So the same thing we're looking for in the SPY, we're looking for in the Qs. And to a certain extent, the same thing we're looking for in the Dow Jones. The Dow Jones is doing sort of the same thing, a little bit weaker from a relative perspective, but we've got that same little bull flag. If anything, it's actually a little bit more clearly formed. And we're still trading just below all-time highs. Now, on the Dow Jones, we're actually a little bit below the 20-period moving average, so you can see that relative weakness in that it's actually already sort of violating the 20-period or trying to. But I think overall it's still holding up pretty close to that, and we still have the same technical level below that, which is this 274. Now, again, to show the relative weakness on the Dow Jones, our last pullback came down to around 273. Now, that wick was a little suspect, if I remember correctly, but basically that's the same level that would be our more important line in the sand, which was the upper edge of the range that we spent most of the summer trading in. Now, again, on the weekly chart, for the most part, it's still the same sort of scenario as the S&P 500 and the NASDAQ, where we've got this broad range that we've traded in over the last couple of years. And then we've got the summer range, which was establishing a breakout through that. And then right now we're holding above that, and we're sort of just stair-stepping upwards. And so we've got room to pull back and still maintain the price action above the previous levels. And I think overall, again, in the intermediate term and the long term, things are pretty bullish. All we're looking for is more momentum in the short term. And in the short term, as you can see, obviously, we've encountered resistance at all-time highs, and we're pulling back. But as you can see, volume has dropped as we've started to pull back. We did have a little bit of volume spike as we dropped at those highs, but we've kind of stabilized and made our way back up. And I think overall, again, the Dow Jones, very much like the S&P 500 and the NASDAQ, is just trading sideways, waiting for new buyers to come in to try to push the price action above. And if the new buyers don't show up and we start to fall back even further, well, as you can see, there are clear levels of support that we could look at to see if the buyers come in at those levels. And so I think overall, particularly with these three indices, the price action is still pretty bullish, and I don't think anyone should really be that worried about the price action. I think a lot of times when we have price action at highs and we stall out for a few days, traders get worried. They get nervous that the market is topping out or rolling over. And I don't think we have enough signals here for us to worry about that. I think at the moment, we should all be looking to trade to the long side, and we should just be waiting for the momentum to come back into the market, at which point we should hopefully get some nice price action to the upside. Again, usually the holidays are a time of nice price action. Cyclically, we tend to get good rallies into Christmas. Last year, of course, was a pretty obvious exception to that. But for the most part, usually into the holidays, you get nice rallies with light volume, and we've still got 2 or 3 weeks left in December. So the hope is that we can break through this current bull flag and start challenging new highs into the next couple of weeks. And if that's the case, we can hopefully finish the year off with a nice bang and see what we can do as far as our approach to next year. Now, in contrast to the last 3 ETFs we just looked at, let's go ahead and take a look at the small caps and IWM. Now, this one has been, in the short term, looks very similar. As a matter of fact, in the short term, relatively speaking, a little bit stronger, right? Because this bull flag is actually holding up pretty close to its recent highs. Now, of course, there's one caveat here. As we zoom out, you'll know that we aren't at all-time highs. We're not even near all-time highs, right? You go back and look further and further, and you'll see where the all-time highs reside and where we stand. So the small caps are still trying to play catch-up. Now, they have done what we wanted to see, which is try to play catch-up while the other indices consolidate, right? Because in the end, what you want is you want all 4 indices moving together. I think typically in strong markets and in weak markets, the market tends to move together. The stronger the market is or the weaker the market is, the more it moves together as all the stocks start to kind of mimic what the market is doing. And we're not really there yet. There's a lot of stocks that are doing their own thing and trading in patterns that are not that highly correlated to the market, at least not compared to what you would typically see in a very strong bull market rally. And so I think that's part of the reason why we've still been sort of flagging and consolidating. Is it seems like the market's trying to get everything together before it tries to make a run. And I think with IWM, and I think the small caps in particular, it's been a very productive month or so since we were able to finally break past this 159 area. That has been a critical level and one I've been harping on all year. And the fact that we were finally able to not just break above it, but when we came back and tested it, buyers came in pretty quick and we had a resounding bounce. I think that's a very strong positive for the potential of a nice rally here. And I think that overall, if you're looking for names to trade, I think small caps offer a lot of upside right now. And if we can get a good rally in the small caps, I think, again, it's indicative of a market willing to accept more risk and an environment in which we should start to climb a little bit more quickly. So this is one of the areas that I'm really focused on. And one of the places that I'm looking at, not only as far as looking for trades, but as far as giving me a better gauge as to what the market's doing. I think right now the small caps are going to lead the way. up or down, and watching them should give us a better clue as to what the market's doing, as opposed to the S&P 500, NASDAQ, and the Dow Jones. Now, that's not to say that the other three indices aren't giving us a good idea of what the market's doing. I think that they're more indicative at the moment of what the market's doing. But if we want to get ahead of the curve and get a good idea of what's going to happen, I think looking at what the small caps do is more important. If the small caps can break out, that's going to lead to a strong breakout across the board. And if the markets, if the small caps falter here, I think it's going to be more indicative of a market that needs more time to trade sideways, at which point we could look at the buy the dip scenarios we outlined on the other three indices. Now, the key levels on IWM are a little bit different. Really, we want to break above 163, break above these recent wicks that have given us some trouble. And if we could do that, as you saw on the weekly chart, well, let's go to the weekly chart. As you see, there's a lot of upside. There's a nice vacuum here of price action between 163 and, say, 170 to 173. There's a lot of potential upside here, and there's a vacuum. There's not a lot of price action here. There's not a lot of underwater buyers that are waiting to get out of this. There's a lot of room here for the small caps to run, and if we could get a breakout, then there's a decent chance that we get a pretty quick move upwards. Maybe not to 170, but at least to the mid 160s. And if we can't, and if we do falter here and fall back, the idea, or hopefully we don't fall back below the 20-period moving average, which would hopefully concur with the S&P 500 and the NASDAQ also holding above their 20. Though that's maybe a less likely scenario. But the key here is that we don't fall back below 159 to 158. As long as IWM stays above that level, I think that the market is in a pretty strong bullish state and is in a spot where we should be looking to trade to the long side and we should be looking to be aggressive. I think if the small caps fall below that, then there's trouble. And I think that's when we start to reevaluate where we stand in the market and what the market wants to do. Now, I'm not saying if the small caps fall below 158, I'm not saying that means the market topped out. It might mean that IWM topped out, but I think it would be more indicative of a market that needs to spend more time trading sideways rather than indicating a market top. Now, that would be the first warning sign of a possible market top, but I don't think it would be enough. I think the other markets, if you look at the S&P 500 and the NASDAQ, they're so strong and their charts have done so well that there's going to be a lot more technical damage that needs to be done before we need to worry about the long-term health of this market. But I will say that if IWM falls back below 158, it's a really big indictment on the short-term health of the market. And I think it would mean that the market needs to trade sideways and continue trading in that range that we spent the last year and a half in, rather than trying to keep breaking out. Now, again, that's not a scenario that I consider very likely, at least not in the next couple of weeks. But it is something we need to keep in mind in case something like that does happen, especially in these Fed days where we could get some explosive price action. Oh, hi, Ray. I didn't notice you typed in there. Hope you're enjoying today's content so far. I hope your trades from the last couple of weeks are holding up for you. And so that's the synopsis of the four major markets. I think IWM is our tell right now. I think it's the one that we want to keep the closest eye on. I also think it's the one that we want to look at its components as far as looking for possible trades. Now, that being said, that doesn't mean we can't trade others. As a matter of fact, one of the trades I recommended this week was in the NASDAQ, and it was looking at a tech name. So we can always look across the board. But what we want to see right now is we want to see the price action stabilize, most importantly on the small caps, and we want to see a breakout above our recent 4-day bull flag across the board, really, but particularly on IWM. And if we see that, then I think we could get a good rally, and I think we can maybe pick up some nice little shopping money over the next couple of weeks as we head into Christmas. All right, let's take a quick look at the U.S. dollar. Then we'll look at gold, oil, and silver. And then once we finish that, we'll get to the chart requests. Those of you that are in here, we don't have a lot of viewers today. I think 3 or 4. If you want to come in and post something in the chat, feel free to do so. I always like to see what charts you guys are looking at. And I can give you my read on the chart and what I think is happening. You can let me know if it's a name that you want to look at. Maybe it's a trade you're in, or maybe it's a trade you are looking to take, or maybe it's just a question you have on a chart pattern or something like that. Anything like that to spur the conversation forward, feel free to type it into the chat. All right, so here's a look at the UUP index. Now, this is the dollar as an aggregate. Now, this is pretty heavily weighted with the euro. So for the most part, this often looks like just an inverse chart of the euro US dollar cross, which we'll get to in a second. But the key here is that we've had the US dollar start to sort of lose momentum to the upside. It hasn't dropped. It's basically trading sideways, and as you can see, it's losing not a critical level, but kind of an important level, and is maybe making its way down a little bit lower. I think overall, it's really indicative of a U.S. dollar that has found equilibrium and is trading sideways and establishing a pretty broad base. Now again, this is due to the euro-U.S. dollar, which is going to be inverse. In this particular chart, up is good for the euro and down is good for the U.S. dollar. And as you can see, it's a mirror of the last chart we looked at. And instead, what we're seeing here is a euro that is starting to establish a bottom and starting to form a decent base after dropping significantly over the last year and a half. And as you can see in the short term, it's starting to gain ground and it's starting to look like it wants to bounce and make its way back up to the 111 to 112 range. We've got the nice double bottom here. We've got the break through 110.60, and now we've got kind of like the bull flag formation as it starts to make its way up above its moving average. So I think overall this is indicative of a euro that wants to make its way higher. However, we got an FOMC day today, and if there's something that gets affected by the FOMC more than the stock market, it's currencies. And so there could be a big shift on this depending on what the monetary policy is that they decide to tell us in the statement. So if that's the case, we could see a much stronger or much weaker U.S. dollar, and that could lead to a big move back or forth on the euro and the other two crosses we're going to look at in a second. But in a vacuum, assuming there wasn't an FOMC day, this looks like the euro wants to make its way up to 111, 112, and that's probably more likely than not what's going to happen. But because of the strong possibility of news today, there's always a chance that it changes. But right now, that's what it looks like. Now, if we look at the U.S. versus the Canadian, and in this one, by the way, up is good for the U.S. dollar. You'll see that the U.S. dollar has started to struggle versus the Canadian. It's really been, it was doing a nice job earlier of climbing all the way to 133, but it found a lot of resistance just below that area, right around 133.10, 133.20, and is starting to turn around and come back down and is really struggling. Now, this is going to be inversely correlated to oil, and part of this is oil has actually done pretty well recently. You can see it continues to climb. It's funny, I found oil to be tough to predict, but in the end, now of course this is hindsight, but in the end it actually has traded in kind of a predictable channel, and is still trading in that channel, and we'll see how long that persists. But oil has actually been kind of a tough one for me to trade recently, because there's been some big swings up and down in this channel that have given us the possibility of that channel failing. But in the end, it's held so far, and it's making its way back up to the $60 area. And we'll see what happens as it starts to make its way up to some tough levels of resistance. But a lot of times what happens is when oil does well, the U.S. Canadian does bad. And that's kind of what we're seeing right now. And again, I think the FOMC statement and the effect it has on the U.S. dollar is going to affect this chart. It's kind of in no man's land right now, where it's pretty far away from ultimate resistance and from support. So at the moment, it's kind of a no-go anyway. So not much to say about this one. Now, the U.S. yen continues to try to hold above this pretty critical line around 108.6. And as we said last week, once it pulled back, it looks like it wants to bounce, but it hasn't been able to yet. This is one that offers a pretty decent trading opportunity for anyone that's into Forex or trading currencies. I know not a lot of you guys are, but if this does break past 108.20, 108.30, there's nice upside all the way up to 109.5 at the very least, and possibly beyond that. As you can see, this was a pretty major inverse head and shoulders that it formed as it bottomed out. You've got the shoulder, the head, and then another shoulder, and then you've got all this mess as it's tried to make its way back above the neckline and slowly make its way upwards. Even in the long run, if you want to look at it, you can even look at it almost like a cup and handle. And I think overall it's indicative of a pretty good bottom in place on the yen, but there's always a chance that fails, and if that does and it loses this area on 108, there's a lot of room to the downside as well. So this thing is in kind of a spot where it needs to move in one direction or the other, and I think whichever direction it runs in, there's potential for pretty good movement. So this is one to watch as a potential trade if you're into trading Forex. All right, so that's the U.S. dollar. That's oil. Now the only thing left to look at is what kind of impact the U.S. dollar has had on gold and silver. And as you can see, gold And silver actually hasn't done much, despite the fact that the U.S. dollar has kind of been stagnant over the last couple of weeks and hasn't really done much. Gold and silver haven't done much either. Now, this is another area that's going to get affected pretty strongly by whatever the FOMC statement is. So we'll see if that changes what's happening here. But as you guys remember last week, I mentioned that I'm not excited about gold or silver right now. I don't like where it is with relation to where it is on its chart. As you can see, in my mind, GLD 140 is a pretty critical price point. It's trading below it. It had this breakdown. It's tried a couple times to bounce and has failed and continues to trade sideways. Now, more often than not in this scenario, it ends up losing support and falling lower, but I think that there's enough potential chance for it to bounce that I wouldn't necessarily outright short it right now, but I'm still not excited about it long until it gets back above 139. And then once it does get above 139, the risk reward's not that great. So I'm not that excited right now about gold or silver. I think a lot of it depends on what happens with the U.S. dollar, and if it could get some bearishness into it, if the U.S. dollar could really start to cave in, then we could see a good strong move here, and we could maybe start making our way upwards. But at the moment, that's not what we're seeing. We're seeing a U.S. dollar that's basically holding sideways. And that's basically what's happening with gold and silver. They're holding sideways as well. If you take a look at silver, sort of the same thing, and a little bit weaker. You can see it actually is losing ground and made new lows. And it's really the same sort of pattern. You've got this level maybe around 1620, and it kind of broke below it, and then it's tried twice to bounce and failed. Was actually printing new lows. And I think if you look at one or the other, I think gold is still better than silver. But overall, I'm not that excited about either one of them. I think that right now, the small caps and some tech names give us better opportunities than what we're seeing on gold or silver. Now, Ray, you mentioned FCX, Freeport-McMoRan, which is copper, is slowly moving up. This is, wow, that's actually not slow. This is pretty, for FCX, that's pretty good. That's good. So that's a good position for you. Been a while since I watched this. In the process of breaking a pretty important downtrend. Interestingly enough, Ray, I don't know if you've taken profits yet or not, but when you have an explosion like this into resistance, it's usually a good idea to take some profits. Not saying close a position, but this is a good spot to go ahead and take a little bit of profit. It's funny because it's counterintuitive. Usually when a stock moves like this, the last thing you want to do is take profits. But I think at this point, this is worth scaling. Not closing a position, but starting to scale some of it out. And then waiting for it to come back and make sure that it holds that breakout. That is a pretty important breakout that it's having today. Again, if we look at the weekly chart on Freeport-McMoRan, this has been struggling for a while now, and while it has basically, in the longer term, really from 2016, if you think about it, it's been trading between 9 and about 15, and it's done a good job here of making its way back up. But in the last year and a half, 2 years, it's been slowly just dropping, and you can see how the moving average is finally starting to kind of turn around. But it is up at some pretty, some pretty interesting resistance levels. There's a little bit more resistance coming up around 14. So there is more upside. But I think generally speaking, with the bounce that it's had recently, it's probably worth taking partial profits. Yeah, well, I guess, yeah, if you say slow. But I mean, you know what? The metals tend to move pretty slow. And so what I mean is, relatively speaking, for a metal name like this, for a miner, that's actually not a bad move. This is not a stock that moves an absurd amount, and for it to move from 8 to 12 over the course of 2 months is actually very strong for it. That's actually a very big percentage move, and I think it's doing really well. So good job on that one. And China-U.S. trade, a lot of industrial stuff. A lot of economic stuff affects it because, of course, copper's used in a lot of different things. So this one is one that is tied a lot to that sort of news. You sold, okay, so you sold your January call, so you are, okay, good. So you did good with that. I do think there's more upside. So this is one you could probably look at. Once it consolidates, you could re-enter some of what you sold. But if you still have part of the position, let it work for you. But yeah, typically when you have a move like this, you want to take at least partial profits because more often than not, it does consolidate, especially after this is a really big breakout. Um, that trend line is not something that you normally just slice through without any consequences. Usually you come back and retest it at the very least. And especially if you're using calls, you don't want that time decay to come in while you're waiting for it to do that. So good job on that one, Ray. Now JNUG, on the other hand, triple leveraged. So the longer that this thing gets stuck, the worse. Now the one thing I will say is the miners, the miners have done better than GLD, right? So that's a positive. If we look at what the gold miners have done, they actually have been better off than GLD, and you can see, and a part of that is because, of course, they're stocks, and if the stock market does well, then they're going to do well. And GDXJ has actually had a nice little breakout off of this channel that it's been sort of descending in and trading sideways. This 36 has kind of been the bottom. I think there's potential upside here. I like what we're seeing here. We had today's bounce was confirmation that we can hold that breakout above this channel. So I would say that the gold miners look better for sure than just trading GLD, and that's the one positive. Okay, so the reason triple leveraged funds always lose value, Ray, is based off the fact that it's triple leveraged. So let me see if I could explain it in a way that it's one of those. It's tricky to explain sometimes, but basically what happens is if this thing moves up, let's say GDXJ moves up 10%, right? And you're going to have JNUG move up 10%, right? So JNUG's going to move up, it's triple leverage, so it'll move up 30%, right? But then what happens next is so let's say we get a 30% move here, right? And that is based off of GDXJ moving 10%. Now, of course, this isn't really 10% on the chart, but I'm just saying, or whatever. We'll say 5%, right? So we get a 5% move, and the other one gets. Now, what happens when we get a 5% move back down? Right? It's keep in mind it's 5% of 41, so it's a little bit lower, right? So now instead we've got, so you get a 5% move up from 38, and then you get a 5% move down. This is a little bit more because 5% of 41 is higher than 5% of 38, right? So what happens on JNUG? Now you're getting, so instead of 5, you get a 15% move up, right? But now instead you're getting a 50% move down on a higher price. And what happens is it's mathematically it's a bigger move. Now that's only part of the problem. The big part of the problem, the other thing that happens is these guys have to invest in gold, and there's fees involved in them having to buy gold futures in order to mimic what the ETF is doing, and because they're doing triple of it, it's just like it kind of exacerbates what you're seeing. There's also rebalancing, which is what Butterface was saying, but the rebalancing works on both, right? Because if you think about it, with GDXJ, these guys are buying gold futures also, so they have to rebalance, right? So there is contango on some of these ETFs. It's not as strong as the triple leverage because the triple leverage one magnifies it. But the triple leverage one magnifies it. On top of that, it exacerbates the moves. Now, Ray, yes, it goes both ways, but it doesn't really go both ways because just mathematically the way it works is it's always going to drop more than it goes up. But you always have that time decay, which is the big problem. GDXJ isn't triple leveraged. This one's triple leveraged. It's GDXJ is just an ETF. Yeah, it just mimics it. And Butterface, thank you. So he put in exactly what you're saying. The product resets on a daily basis. Math dictates that each time there's a directional change, you lose some value. And that's just the way it works. It's just over the long run, you're going to lose that value. It's not going to. It doesn't seem like a lot, but it definitely it's definitely exacerbated the longer and longer you hold a position. And thank you by the way. That it's much easier when you type it out than sometimes it is to explain in words. But it's just a function of the way these things work. And so in the short term, like you said, you're like, oh, it goes both ways. In the short term, yes, and that's why these things are good to trade in the short term. But in the long term, no, because the longer and longer you hold it, the more that math works against you. It's sort of the same as buying options, as buying premium. The longer and longer you hold an option, the more likely, the more chances that premium works against you. And it's the same with these triple leveraged products. And so yeah, so that's why now I'm not, I don't think that these things are always bad to trade. My brother trades them sometimes, and I trade them sometimes, and it works well. Um, yeah, short term, one day. Yeah, I mean it depends. Some people just day trade this, and it works great because you're getting, like I said, the metals don't really move that much, and with if you really want to, you would do this if you can't trade futures, and there's a lot of margin on gold futures. Um, but in general, you're better off shorting these if you're able to, and that tends to work. Especially you do. It's not just this. It's there's a lot of like you got the market ones like TNA, um, which again, if you just look at the weekly chart, Ray. The one thing is too is like if you don't really understand the math that well, you can always just look at the weekly charts of these things and see how they behave and see especially if you go to the monthly chart on these and you see what you can see the decay. It's evident. So even if you don't if you can't really wrap your head around the argument as to why, uh, just take a look at what happens to them in the long term. Take a look at TNA. Now TNA this has been a major bull market, so it has climbed, but it hasn't climbed. It's still nothing like the drop that we're seeing on TZA, right? And so that's kind of the issue is that these things over the long run will eventually decay to the point that they're useless, and you need a massive rally. You need something like what we're seeing in the market now in order for these things to hold up as long as they can. If you look at JNUG again, you look at so this is the one we were talking about. You look at what JNUG has done over the since 2014, so 6 years now. And this thing never traded at $4,000. It's just split adjusted because these things always reverse split when they get to a certain price point where they're just not worth trading anymore. Right? So, kind of like a lot of people that don't understand quantum mechanics at all. Matter of fact, most scientists don't understand quantum mechanics, but that doesn't mean you can't use it if if you at least figure out what it does, right? And it's sort of the same with this. You don't need to understand sometimes the math as to why it works, but if you just look at the chart, you can see it's evident that it works or it doesn't work, and what happens, right? And so, in this, you could tell that this is just something that decays over time, and it's not worth holding for longer periods of time. It's just the way these things work. So, in the short term, they're definitely worth trading, and they're worth trading in very strong trends because, as long as the trend is prevailing in one direction, you're going to get more opportunities for it to move triple up. But once it starts to stagnate or once it starts to trade sideways, you start to really, that's when the decay really starts to creep in. And again, Butterface, thank you for typing it in words. So for anyone that can, maybe didn't, it's easy to get wrapped up in it when you're trying to say it in words and verbally, and it's nice to have it written out. All right, so yeah, that's basically what happens with these, and why I typically tell you not to stay in them long, because the longer you hold them, and I know, not to pick on Ray, but Ray one time day traded this and ended up holding it for months, and it was just a position that it was just going to keep going against him, because once you get stuck in it that long, it's just the math is not going to work in your favor unless you get lucky with a good bounce. All right. Anyone else have anything else they want to look at? Oh God, you still do, Ray? Oh Jesus, that's Ray. That's been a long time to hold that thing. Sometimes you just have to accept the loss. I think that's something all traders need to learn. Is you tell yourself, well, it's almost break even. I just need a little bit more time. But the truth is, sometimes that money could have been. You could have just closed that trade, taken your loss, and then moved it somewhere else that works better. You know. I think that's something a lot of traders forget when they're in a position, they want that position to get back to break even, is they forget that in the long run you could have made that money back up with another trade. All right, so let's take a look while I'm waiting. Hopefully someone else has something to talk about. I don't have a lot of stocks to talk about, but one I do want to talk about is Amazon. I put this yesterday on my Patreon page for those of you that go to the Patreon or not. If not, just so you know, you can always visit me at patreon.com/stockdarts, and I post blog content on there. Sometimes it's free, sometimes it's subscription based, but the subscription based stuff it's not that expensive and often goes free after a certain amount of time. So it's always worth your while to go in there and look at it. Even if it's maybe after the move happened, you can still get an idea of what I'm looking at and why I'm looking at things. But I wanted to point out Amazon, and this is the kind of name that I'm hoping works well if we have a Christmas rally. Now, it's not really working at the moment, but that's part of trading, right? You put up an idea, but it didn't trigger yet, and so the idea behind this was it's struggling behind the market. But typically, if the market has a Christmas rally, Amazon is one of those names that tends to do well in Christmas and tends to move strongly and highly correlated with the market, right? And it's been struggling, but it's been trading a nice little channel, and we've got this nice level around 1750 that has been sort of an intermediate level of not necessarily support, but a critical price point that it's been going back and forth through, and it's recently been kind of stuck at the bottom of this channel and trading just below that 1750. And so my thinking is, if this thing could get back above 1750, it will of course mean that it has established the bottom yet again in this channel, and likely wants to try to make another run up towards the top of that channel, or at the very least up to the 1800 to 1820 range. So this was my post for yesterday. What I wanted to put on here was not just that this is what I'm looking at, but to point out the idea that you often want a trigger when you're looking at a trade. You want to figure out not just what's possible, and this goes back to that discussion we had earlier when I was saying about the market, about trading. It's not necessarily about predicting, but it's about trying to outline a potential scenario, and then if that scenario occurs, then you react and go ahead and enter. And in this particular case, my idea was that there's a chance that this thing could bounce and rally, particularly if the markets rally. And if so, it should have some nice upside. Now, what needs to happen for that to occur? Well, in my mind, it needs to find support at the bottom of this channel, and I think if it got above 1750, that would be confirmation that enough buyers stepped in to get it to bounce. And then from there, my thesis is that it would make its way back to the top of the channel. So, more than anything, I just wanted to show you guys the thought process behind how I would approach a swing trade. Now, of course, this thing could fail and head back below 1730. If it does, well, then the trade never triggered. And if we do get a bounce above 1750 and then it rolls over, well, we stop out. What we have here again is something that's really critical and something I've discussed in the past, which is you don't want to just protect your money. You want to protect your mental energy and capital when you're trading, right? So a lot of times I want clear-cut decisions so that I'm not emotionally tied into a trade and letting my emotions get the better of me. So in this particular case, we have very clear-cut entry, we have a very clear-cut stop, and we have a very clear-cut profit target. And it's all made, it's all dictated by what the trend lines are telling me. So when I'm in the trade, I don't end up doing something like getting stuck in the trade because I'm hoping that it stays or that I'm hoping that there's always a chance that it rebounces. I know exactly when my trade is wrong. My trade is wrong if we fall back below this channel, or it doesn't even trigger if it falls below that channel. And if it does trigger, well, I know when my trade is right and I know when it's wrong. And so, not only am I protecting my financial capital with this, but I'm also protecting my mental capital by having most of the decisions made by the price action rather than by me, who could be emotionally invested in the trade to begin with. All right, so let's take a look again. Butterface, you want to look at Walmart, and Ray, you want to look at Microsoft. Now, Ray, you mentioned this. Microsoft, you was a name you were trying to short last week, and I mentioned that it was probably not a great idea to try to short this because again, it's been so strong. You sold your spread at 110. It's currently 126, so you're down a little bit on it. Not the end of the world. The good thing for you is the market has been stagnant and trading sideways, and that helps when you're doing call spreads. Um, you have December. Okay, so it closed. It expires on Friday. 165, 167. Wait, on which one do you have 160? You don't have 165 on this, right? That's pretty far out of the money. That's probably pretty far out of the money. That was on something else. Oh, JDST. Sorry, there's a lot of. Okay. Nope, that's not it either. Well, okay, there we go. 150, 152. All right, yeah. So I mean, you're kind of stuck. You're right at it, right? So I think a lot is going to be dictated by what happens there, Ray, um, with FOMC. And if the market rallies, then you're going to lose in this position. If the market stagnates, then this could work in your favor. You're right there. You're almost at break even. You're not that far out of the money yet, and it's going to depend on what happens. But I think in general, this shows you again what I was saying about the market is even if there's some bearishness in this, because the market is so strong, because this name is so strong, it's having a hard time dropping. And that's what makes that trade tough. And I think this is what we were discussing last week, which is that this makes it hard on you mentally because you're trading something against the current grain of the market, and you're trading something that is struggling to drop because there's just so much demand in it, and it makes you doubt your process, and it makes you doubt your position, which makes it harder on you mentally to trade. And that's why I brought up the Amazon example. It's not even a trade that's working at the moment, but just to give you an idea of how I structure my trades so that I don't have that mental anguish when I'm in a position. Everything is clear cut and decided for me, and there's not a lot that needs to be done mentally for me in order for that trade to kind of materialize itself or resolve itself. All right, now that's good, Ray. So Butterface, you want to look at Walmart. Now, interestingly, Walmart. I've actually been looking at Walmart, and part of it was because I was looking at Target. And Target has done way better than Walmart at the moment, but you can see the nice strong moves coming out of it. And Walmart, not that Walmart's been weak, but Walmart's been kind of stuck. It had this big move on earnings. It had a really strong earnings report, but it faded it almost completely, and it kind of came back. Now, if we ignore that earnings candle, it's actually not too shabby what we're seeing here. Now, today's candle's not good. Um, that's a pretty important area, that 120. But I think that this is not too bad. I don't like today's candle. If today's candle was bullish, I think that this would be a chart that's starting to make its way back up. Now, I do have an issue with this from a trading perspective, and that is that at the moment, if we look at it, and what we're going to do here, let's just clone this. Um, let's say basically from right around there, right? So if you look at what it's done, it's been kind of stuck between about 121 and about 117, and it's right in the middle right now of both of those price ranges. So it's been stuck. It's been stuck trading sideways. Um, especially after the earnings report, and it's trying to, it's exactly what I was saying before. You have, we'll go back to the solid lines for this, and we'll do, we'll do white just so that it's easier to see what I'm talking about. So you have a strong move, and that strong move is typically followed by a sideways move, right? Same thing happened. You had a strong move, then you have the sideways move, right? You have strong move. Now this one wasn't sideways, so it's kind of a pullback, but you get the general idea. You tend to have, you have a good move, you have consolidation, good move, consolidation, good move, consolidation. So we're waiting for the next move, right? Whether, and it could sometimes be down, not necessarily up, but it's consolidating and trying to get enough momentum up to start its next move up. Now that being said, there's just as much downside as there is upside at this particular price point. So I did like that little wedge that it was forming, which kind of manufactures a little bit better risk reward because you can always put your stop just below that breakout. But that didn't work out, and it was, especially with today's candle where it's dropping right back. I think at this point we want to watch it either come all the way back to 117, or we want to see it establish a better pattern to be able to push a breakout past 121. So I kind of like this the idea of trading Walmart into the holidays, but when I look at the chart itself, I don't think it's presenting an opportunity at the moment. So this is one that it's just I put it on my watch list and I wait because at the moment I'm struggling to find a good entry with a good target. So just, if we want to go ahead and go back to that Amazon parallel, what's the thesis for a play on this? And the idea is that it needs to break this consolidation, but it's right in the middle of that consolidation. So for now, I don't really have what I would consider a good trading setup on it. I think it needs to either come back to the bottom of that range, at which point our trade thesis will be it's trading in a range and it's at support, so it should make its way up, or that it starts to break through this and then our trade thesis is it's finally ready to start its next rally, at which point we would hopefully find a good risk-reward scenario based off of whatever pattern it prints. But for now, it's just that's what it's doing, and I'm watching it. I have been watching it actually, but it doesn't have a clean enough entry for me to want to go ahead and try to trade it. And actually, like I said, I think Target's showing not only more strength but a cleaner possibility. Let me get rid of these trend lines. And so again, you can see Target. And it's funny because Target's actually doing something very similar, where it had the recent pullback. And then it's doing the same thing. It kind of broke out and it's kind of fading back. But this one, it's just the momentum has been so much stronger. But it's funny in a macrocosm, it's still the same. It's still the same thing. It's, if you look at it where it's at versus support and resistance, it's right in the middle. Right. But it just has a cleaner pattern and momentum that could be trusted a little bit better. Ray, these things are always recorded. Now you can find the recording on Twitch, or you could visit me. You can visit the patreon.com/StockDarts, where I always repost the. It's even on YouTube. So there's 3 different places you can get the recording. You could get it on Twitch. I think Twitch keeps all the streams archived. You can find it at YouTube, or you can find it at patreon.com/StockDarts. Just follow me on Twitter when I post a link, or just visit those, and they'll be up there. Okay. All right. You said, can I comment on JNUG? JNUG at December 20th. So you bought a call on what price? What price? Like what strike? What strike did you buy? See, Ray, here's the issue. You you're buying calls which decay on an ETF that decays. You understand how you're putting yourself in a position to fail, right? Because you're buying calls which decay over time on an ETF that decays over time, and you're waiting a month or 2 months for it to work in your favor. So all the math is against you. Like you could have the right read on the chart, and you can have even good timing on it, but if your time frame is wrong, it's going to work against you just because of the way math works, the way options decay and the way these ETFs decay, right? So you paid $7.55 for it, and now it's trading at 368. So you've lost almost half of it, right? And you want to roll it, so you don't want to give up on the position. You want to roll it and hope that it works in your favor. I don't know that that's a good idea, right? Because what you're doing is you're fighting against the current. You're like a little kid on the beach, and the waves just keep crashing on him, and he keeps standing right where the waves break, and just letting them all kind of hit him. It's really hard to push past that because you have to go through so much. You have to go through so many things that are going against you. You know, you see gold moving up. Well, Ray, I don't think that there's anything wrong with trading the gold miners. My problem is that you see gold moving up, right? And that's fine. Everyone has their own ideas. Everyone wants, you have an idea of what's going to happen, and everyone's entitled to it. And you can see something on gold that I don't see, right? And that's fine. But if we go back and we take a look at what gold has done, just from November, right? It's gone sideways. We look at it, what it's done since August. It's gone sideways, right? So I don't want to argue with you that gold could go up, because it could go up. It could go up from here just fine. But what you're doing here is you're trading an instrument that decays over time, using an instrument that decays over time, and it hasn't moved. And now I'm not saying, of course, it's gone up. You look at it from May. I'm picking arbitrary price points, and you could pick arbitrary price points. But what's happening here is you're using the wrong instruments to trade this, and it's penalizing you heavily. Because if it doesn't move over a month, you lose half of your trade, even though the trade is only down maybe $1 from where you entered. And so that's the problem. So if you entered in November, and we'll go to JNUG. Actually, well, yeah, we'll go to JNUG. So, I don't know where you entered, but if you entered in November, this trade should be up. It shouldn't be down half its value. Right? I mean, November, maybe you bought here. I don't know. But for the most part, almost all of November, it's traded below where it's trading now. And despite that fact, this position has lost half its value. Why? Well, because calls are always going to lose value. And on top of that, this thing decays the longer it trades sideways. And so, there are different ways of trading it, whether it's through GDXJ, whether it's through trading, like I said, KL would have worked against you because it had that gap down. But, there are other opportunities and other ways of trading. And you can look at other gold miners. And again, you take a look, actually gold miners are starting to come down, which might indicate that JNUG or some of these others are going to follow it. But there are other ways of trading where you don't have to actually trade just GDXJ or JNUG or anything like that. You look at Barrick Gold, and this one again is doing okay, and it's doing better. And this one doesn't decay. And at the very least, if you have to use calls, you're not using calls on an instrument that decays. You're using calls on an instrument that at least trades normally. And again, Ray, I'm not trying to say that the idea that gold can move up is wrong. There's always two sides to any trade. But what I'm telling you is that the way you're structuring your trade, you're penalizing yourself because you're fighting math on a number of different fronts. And I think that's really hurting you. Um, this used to be Barrick Gold. Well, see now Barrick. That's the Toronto. They changed the ticker, and so on the U.S. exchange it's GOLD. But that's this is on the Toronto exchange. Um, I mean that's a problem though, Ray. If you want faster action, because um, trading shouldn't necessarily be about just faster action. Now, you do want return, and you want it to work in your favor, and that's why that's what these are for. That's what JNUG is for, is for faster action. But the problem is that you don't want to close a trade that doesn't work in your favor, and when that happens, you end up holding this position much longer than you need to. I'm not, JNUG is there for that reason. It's there because it gives you faster action, it gives you faster returns, but the longer you hold it, the more it just works against you. And that's going to be the same thing with calls. If you're buying calls purely for leverage and purely because you want faster action, well, you have to understand that once you hold a call for 2 weeks, if that trade didn't work in your favor, it's almost impossible for that trade to come back for you unless you get a really, really big move. And so you have to understand that it's hard enough to pick a direction on a stock and for it to work in your favor, let alone trying to fight the decay of options, let alone trying to fight the decay of the ETF that you're trading. When you factor all that in, that's giving you a much higher chance of failure on the trade, even if ultimately you were right on the direction. And hopefully this helps for those of you that are in here that are watching and maybe haven't commented. There's so much that goes into being a successful trader or being a profitable trader, and it's not always your ability to read a chart. It's your ability to understand the forces that are in your favor and against you, and trying to put them to work for you. And that's one of the things I always do during earnings season. Earnings season is a very highly unpredictable time for stocks. They can move back and forth a lot of times randomly. You can have we'll go back to Walmart, and a stock could have a really good report, and it ends up giving it all back, and the market says, well, we knew it was going to be a good report, we wanted better. Or they could have a really bad report and it still takes off on you. And yet I always do well trading earnings season because I understand the math of options, I understand what works, and I find a way of trading the volatility of earnings season in a way that the market is in my favor, that the decay works in my favor. And I take advantage of the normal behavior of options and the normal predictability of volatility on typical stocks, right? And so you try to get as many of these edges in your favor as possible. And when you don't have that happen for you, you end up having these trades that just bleed away on you because it's not that you even have the wrong idea of what's happening with the stock. It's because the instruments you're choosing are penalizing you heavily if it doesn't work in the first week or two of holding a trade. And in that sort of scenario, I don't want to completely discourage someone from trading calls or from trading a triple leverage fund like this, but you have to understand that when you trade something like this, you don't just have a stop in place based off of a price on the chart. You need to have a time stop and say, well, if this trade doesn't work in a week, then I'm going to close it because I timed it poorly, and it's going to continue to decay on me the longer I hold it, right? So you have to understand when you trade something like that, if you're just buying calls, if you're not using call spreads, if you're just straight up just buying calls, buying volatility, or if you're trading a triple leverage fund like this, that the longer you're in it, the worse your odds are of ever succeeding on that trade. So you need to tell yourself that if it doesn't work within 1 week, or if it doesn't work within 3 days, or it doesn't work, whatever time frame you're using, that you just close the trade and look to initiate a new one when the chart gives you a better opportunity to go ahead and get in. And that's going to help you a lot, and it's going to give you a much better opportunity of being on the right side of these trades, because a lot of times, like I said, it's not that easy to pick to get a direction right on a stock. there's a lot of randomness in the way stocks move, and I think in the long run, if you look at it, yeah, there's some inherent predictability to the way things move, but from day to day, there's still a pretty random nature to it, and the last thing you want to do is add more variables that are going to go ahead and stack against you and make things make life harder on you. Okay, so I think I'm going to end it there. I hope that helped. I hope that gives you guys a better idea of what kind of forces you're going against when you're trading, and understanding that when you try to trade, there's a lot that goes into it and a lot that you have to account for. And the more you have a detailed trading plan and the more you have each one of those factors or variables accounted for, the better chances you have of this working for you. Okay? If you guys have any questions, if you feel like maybe you want to keep discussing this in a different forum, you can always message me on Twitter. You can email me, stockdarts@gmail.com. I'd be more than willing to help out. Or you can visit me on Patreon and look at some of the things I post on there and comment as well. And I'd be more than happy to help you with anything you have. If you're looking for mentoring, you can always message me as well, and we can set up a session or two to see if we can get some of these factors a little bit more hashed out and a little bit more in tune with whatever it is you're looking for. Other than that, I hope you guys have a good rest of this week, and we'll meet again next Wednesday. Ray, I'm not going to be around for FOMC anyway, so I wouldn't be able to, but I don't think that there's much value that you would get out of it anyway. I'm not that big into news. I'm more into the technical analysis anyway, and a lot of times with the FOMC, it takes an hour or so for that to really, for you to get a good idea of what's going to happen with it, so I don't think there's much usefulness to it, but we'll see. But alright guys, have a good rest of today.